The Federal Reserve's survey of consumer finances found that the median retirement savings for Americans between 40 and 55 sits just under $100,000. That number sounds reasonable on the surface, but stretched across a 20 or 30-year retirement, it tells a very different story. Because retirement is not a moment. It's a long-term financial system that needs to sustain you without income. And when you look at that number through that lens, something becomes clear. For many people, the margin for error is already gone. Your 40s are not just another decade. They're the decade where two separate retirement paths begin to visibly separate, one towards stability, one towards pressure. And what makes this separation dangerous is that it doesn't feel like a turning point. There's no obvious warning sign, no dramatic financial collapse, just small decisions repeated consistently that quietly shape the outcome. The compounding window is narrowing. This is where the math starts to matter more than intuition. Compound growth is not linear. It accelerates over time, which means the earlier years carry disproportionate weight. At 25, you have roughly 40 years of growth ahead. At 45, that window has compressed by more than half. A single dollar invested at 7% annual return at age 25 becomes approximately $14 by retirement. That same dollar invested at 45 becomes about $4. That difference isn't just about time, it's about missed acceleration. Because the most powerful phase of compounding happens in the final years, when the base has grown large enough to generate meaningful returns on its own. If you start late, you don't just lose time, you lose the phase where compounding does the heavy lifting, which changes the entire strategy. In your 20s and 30s, time can compensate for inconsistency. In your 40s, it can't. The equation flips. Progress becomes more dependent on contribution rate and discipline than on time alone. And that's why this decade feels heavier financially, because each year now carries more consequence than the last. The catch-up illusion. A common assumption people make in their 40s is this: I'll catch up later, when income is higher, when expenses settle down, when things stabilize. But in practice, that catch-up phase rarely happens the way people expect. Because the same factors that delayed saving earlier, lifestyle, obligations, unpredictability, don't disappear. They evolve. Children get older, not cheaper. Houses require maintenance. Care responsibilities often increase, and career pressure peaks. So instead of a clean catch-up window, most people experience a more complex financial landscape. Higher income, but also higher structural expenses, which means the ability to catch up is narrower than it appears. And more importantly, it requires intentional design, not just hope. Lifestyle inflation is the quiet wealth killer. Many people assume financial stagnation comes from a major mistake, a bad investment, a market crash, a job loss. But more often, it comes from gradual upgrades that feel completely justified. Income rises, housing improves, the car gets better, vacations become more frequent, subscriptions stack quietly in the background. And none of these decisions feel wrong. In fact, they feel earned, which is exactly why they're dangerous. Because they normalize a higher baseline cost of living. And once that baseline shifts, it becomes very difficult to reverse. The issue isn't spending, it's fixed spending, expenses that are difficult to reduce once committed. Housing is the biggest example. A slightly larger mortgage doesn't feel like a big change month to month, but over time, it reduces your financial flexibility, it limits your ability to invest, and it increases your exposure to risk. Lifestyle inflation doesn't show up as a mistake.
It shows up as the absence of progress. Years go by, income increases, but net worth doesn't move the way it should, and that gap is rarely questioned.
The debt drag problem. Debt in your 40s behaves differently than debt in your 20s. Earlier in life, debt is often temporary, a bridge, a tool. But in your 40s, debt tends to become persistent. Car loans get replaced with new car loans. Credit balances rotate instead of disappearing, and monthly obligations become embedded into your financial structure. Research from the Employee Benefit Research Institute found that Americans carrying significant consumer debt into retirement were 3 times more likely to report financial stress in their 60s. 3 times. Because debt doesn't just cost you interest, it competes with your future. Every dollar going toward debt repayment is a dollar not being invested. And in this decade, that trade-off becomes extremely expensive. A $1,200 monthly debt load might feel manageable, but invested over 20 years at a 7% return, that same amount approaches $600,000. That's the hidden cost, not what you pay, but what you never build. The savings benchmark most people never check. There's a benchmark that rarely gets discussed clearly. Fidelity's retirement research suggests 3 times your salary saved by age 40, 6 times by age 50. For a 45-year-old earning $90,000, that implies around $360,000 in retirement savings. Many households fall short of this benchmark, sometimes significantly. And the problem isn't just the gap, it's the lack of awareness of the gap. Because without a reference point, it's easy to assume things are fine. This benchmark isn't a judgment, it's a calibration tool. It tells you whether your current trajectory aligns with your long-term goal. And if it doesn't, it gives you time to adjust. Because the 40s are still a recovery decade, but only if the problem is clearly defined. The structure of a strong financial system. By this stage, retirement success is less about individual decisions and more about system design. Strong financial outcomes in the 40s tend to follow a structure: a controlled cost of living, a consistent savings rate, minimal high-interest debt, and automated investing. Not extreme discipline, not perfect timing, just a system that reduces friction and protects progress. Because the real risk in this decade isn't making a bad decision, it's defaulting into inaction, letting expenses expand naturally, letting investing become inconsistent, letting priorities drift. A strong system prevents that drift. What comfortable retirees actually do differently. Vanguard's long-term research on investor behavior revealed something important. The most consistent predictor of retirement success wasn't income, it wasn't intelligence, it wasn't even investment selection, it was behavior. Specifically, consistency, automation, and resistance to noise. Households that contributed regularly, regardless of market conditions, significantly outperformed those who adjusted their strategy based on headlines or short-term volatility. And this matters more in your 40s than any previous decade, because this is when life becomes the most complex. Career pressure peaks, expenses are high, time feels limited, and under those conditions, consistency becomes harder, which makes it more valuable. The people who succeed financially in this decade don't necessarily do more, they just interrupt the pattern of stopping and restarting. They remove decision fatigue, they automate contributions, and they let the system run. The risk of delaying just 1 year. One of the most underestimated risks in your 40s is short-term delay.
I'll increase contributions next year. I'll start investing again after this expense. I'll fix it once things settle. But in practice, delays tend to compound just like investments do. 1 year becomes 3, 3 becomes 5, and suddenly a meaningful portion of the remaining compounding window is gone. Because the timeline is no longer flexible. You're not working with 40 years anymore. You're working with 15, maybe 20, which means each year carries a disproportionate weight. Delaying progress in this decade isn't neutral, it's expensive. Conclusion. Your 40s are not a financial emergency, but they are a structural turning point. The compounding window is narrowing, but still active. Lifestyle inflation is manageable once it's visible. Debt is solvable with deliberate prioritization. And the behaviors that drive long-term financial security are not complex. They are consistent, automated, and protected from short-term noise. The gap between retiring comfortably and retiring under stress is rarely the result of one major mistake. It's the accumulation of small, unexamined patterns, repeated quietly over time. Your 40s are the decade where those patterns either get corrected or become permanent. The window is still open, but it no longer stays open by default. If this gave you a clearer perspective, consider subscribing. We break down how money actually works, without noise, without hype.